In today's video, I'm going to talk about the differences between discretionary, systematic, and quantitative trading approaches. There are many different levels of analysis and perspectives we can use to compare these distinct approaches to trade the financial markets. In a first moment, I will explain the difference in definition between these three types, and in a second moment, I will make a comparison between them so you can visualize the pros and cons of each one more clearly, and maybe perceive a few details about their application that are not so obvious to most traders. We begin by defining the three types of trading approaches. Discretionary trading strategies are the ones who have general rules and guidelines about technique, risk, and behavior, but the application of these rules and guidelines depend on the discretion of the trader using the strategy. In other words, there is subjectivity on the way the strategy is applied. That means that each trader will experience different results because their personal judgment is part of the strategy. You might ask, why would there be subjectivity in a trading strategy in the first place? And the reason for that is because it's really difficult to tell a computer how to recognize certain things on a price chart, for example. Things like recognizing major and minor flows, the battle between buyers and sellers, the correct places to draw frequency lines, pitchforks, and the overall contextual analysis is something relatively easy for human traders. But if you try to program all of that into a computer, you will face some incredibly difficult challenges. Some might argue that these challenges are almost impossible to solve. The most sophisticated trading algorithms today use neural networks, which is a type of computer program structure that attempts to emulate the way the human brain works. Even though the neural networks of today can do amazing things like computer vision, self-driving cars, and many other things, the complexity of a price action analysis is still not in the horizon. When we talk about advanced price action analysis, traders should remember that the best neural network in the world is still inside their skulls. Even though our brains have this amazing analytical power, they also have some flaws we're going to discuss later. In summary, discretionary trading strategies don't have completely black and white rules because subjectivity emerges in the attempt to analyze the complexity of price. Systematic trading strategies, or trading systems as they are usually called, are completely black and white sets of rules that totally eliminate the subjectivity out of trading. The vast majority of trading systems is based on techniques that are easy to automate, like technical indicators, and techniques that come from some sort of simple mathematical formula applied to price charts. The main advantage of such systems is that they do not need human intervention. That comes with a great cost. Trading systems are usually built using smoothing filters like different types of moving averages and other slightly different indicators with the same basis. The issue with that is that smoothing filters always introduce lag no matter how sophisticated they get, and this greatly diminishes the quality of the entry and exit signals and of the system as a whole. There's also the big problem of choosing the correct indicator periods, which change unpredictably from time to time. Computer simulations and backtests can identify the optimal indicator parameters, but they cannot predict how the optimal parameters will change and when they will change. Trading systems are also very sensitive to small changes in data and market friction, meaning transaction costs. So sometimes the system might appear to be profitable in the testing phase, and it completely falls apart in real time. Another big problem of trading systems is that once you do find a profitable system, it has an expiration date. Not many people know about this, but trading systems that actually work only work because they are able to capture some sort of inefficiency in price. But such inefficiencies don't last forever. So the system might work for a few years, or maybe a few months, or even just a few weeks. And then the conditions in the market might shift, and the inefficiency that was allowing the system to be profitable might vanish. The problem with systems is that they assume certain characteristics of the market are rigid, and there is no sufficient level of optimization that will override the constant changing dynamic of the market. This rigidity of trading systems doesn't happen in discretionary strategies. Since subjectivity is allowed into the analysis, the strategy can be used in any market condition with a great level of adaptability. That means that a good discretionary strategy doesn't have an expiration date like a trading system does. Like in many areas of trading, there is a trade-off between the adaptability of the strategy and the level of objectivity involved. We also have the quantitative strategies, also referred to as quant strategies. This is somewhat of a special kind because it's like a mixture between the discretionary and systematic approaches. Quant strategies are usually based on some sort of mathematical model or econometric model with greater scientific basis, but at the same time, the trader has a level of discretion to pick and choose between the available opportunities. That doesn't mean these methods are subjective. It means that among the opportunities found by the model, the trader can choose the ones that fit his level of preference and risk. Not always though. Certain quant strategies are fully automatic. Quant strategies require an analysis algorithm which will analyze many different financial instruments using the econometric model and filter them according to this model in real time. Once the opportunities are identified, the trader can choose the opportunities he will take according to the model, and then an execution algorithm is needed to actually place orders, because many quant strategies require simultaneous trades to be executed, and also a connection between analysis algorithm, execution algorithm, and broker with low latency. The two main problems with quant strategies are learning the econometric model behind them, which is difficult without certain prerequisites, and having the correct infrastructure to analyze and execute trades in real time. The application of the method is actually very simple once you learn the model and you have the infrastructure. Now we have an idea about 3 different trading approaches, so let's begin comparing them, giving a few perspectives. We will also analyze some of the implicit trade-offs in these approaches. We are going to analyze these approaches using 10 different perspectives. The first parameter is the objectivity-subjectivity spectrum. Imagine that a trading method can be fully objective, fully subjective, and everything else in the spectrum between these two extremes. Knowing that is helpful for people who are more inclined to objective rules and people who don't mind some subjectivity in the analysis given the benefits that open up when you add the subjective element. The second parameter is the opportunity cost of the trading approach. In economics, the opportunity cost is everything you give up in order to act in a certain way. We're going to analyze the opportunity costs of the different trading approaches primarily in terms of time. For example, if a trading approach requires that you spend too much time in front of the computer scanning opportunities and analyzing the market, it has a high opportunity cost because you need to give up a lot in order to apply the strategy. The third parameter is the level of potential automation, meaning how much of the approach can be automated, which directly translates into a lower opportunity cost. This is a sensitive point because a low opportunity cost is deeply attractive, but at the same time, there are many problems that come along with that. The fourth parameter is the level of adaptability of the trading approach. That relates to how flexible the trading techniques are and how capable they are in capturing dynamic market scenarios that change unpredictably. The fifth parameter is the expiration of the trading approach, meaning if the approach depends on market inefficiencies that might disappear without notice. That's important because we want to use generalized trading techniques, meaning techniques that work in any market and time frame, not just in one specific situation. The sixth parameter is the learning complexity, which relates to how easy it is to learn the concepts in the various trading approaches. This is critical as it will determine towards which type of approach most people will gravitate. Once again, the simplicity to learn attracts people for obvious reasons, but this simplicity comes with a cost. The seventh parameter is the necessary infrastructure to apply a particular trading approach. For example, the types of platforms, algorithms, and brokers you need to actually use a particular approach. The eighth parameter is the applicability, which relates to how easy or simple it is to apply the trading approach once it is learned and the necessary infrastructure is present. The ninth parameter is the scientific backbone, which relates to the level of science supporting the trading approach. This is important because methods based on sound scientific principles have a better chance of performing more efficiently due to the fact that scientific theories need to pass through the rigorous scientific method. The last parameter is trade quality, which relates to the accuracy of trades generated in each trading approach and also to the relationship between risk-reward and the possibility of measuring probability of success. Starting with the first parameter called objectivity-subjectivity spectrum, we have discretionary strategies living somewhere in the middle. That means a discretionary strategy will have both objective and subjective elements. Certain nuances in a price action analysis are necessarily subjective, for example. However, certain rules about the techniques in risk management are completely objective. How the trader will deal with the behavioral aspect of the strategy is, of course, subjective. Trading systems, on the other hand, are fully objective, meaning that all the rules in the trade plan are objective. This might seem interesting at first glance, but the elimination of subjectivity carries a reduction in trade accuracy, the introduction of unpredictable expiration dates in the system's rules, and lack of adaptability. Quantitative strategies are not exactly fully automatic, but they live very close to the objective end of the spectrum. That means there is some discretion since the trader can pick and choose between many trade opportunities that are filtered through an analysis algorithm. You can view many quantitative strategies as semi-automatic, trading systems as fully automatic, and discretionary strategies as manual. Let's now move on to the second parameter, which is the opportunity cost of each trading approach. Discretionary trading strategies tend to have a higher opportunity cost because the trader needs to wait for opportunities to align in a particular way. And since the analysis is heavy, the trader cannot keep track of too many markets at once. However, there is a trade-off between opportunity cost and trade inaccuracy when we talk about discretionary strategies. The trades you are able to find with a discretionary strategy are the most accurate of all. But that implies you need to spend more time in front of the computer waiting for the right time to act. The more time you spend scanning and analyzing the market, the higher your chances of finding more opportunities, but at the same time, the higher your opportunity cost. Most traders don't think about that, but it can be a problem since you can spend too much time waiting for opportunities to align properly. Trading systems, on the other hand, have a very low opportunity cost because they can be fully automated. But as the trade-off between opportunity cost and trade inaccuracy suggests, the quality of trades and their accuracy are greatly diminished. Quantitative strategies sort of have the best of both worlds. The trades generated indeed have good quality, higher than what you see on any trade system, and at the same time, most of the heavy lifting is made by the analysis algorithm. In other words, quantitative strategies live near the perfect balance point of the trade-off between opportunity costs and trade inaccuracy. From the third perspective, which is the level of automation, discretionary strategies cannot be automated at all, or at least not to any significant degree to enable the opportunity cost to be reduced. Here we have the obvious trade-off between automation and opportunity cost. The more you are able to automate the trading process, the lower your opportunity cost. Discretionary judgment cannot be automated simply because it's too complex for a computer, even with artificial intelligence. Computers have what's called narrow intelligence, while human beings have what's called general intelligence. Narrow intelligence means that the computer can be extremely efficient in one single task and incapable in all the other tasks. General intelligence means a good level of skill in a variety of tasks, which is what's necessary to analyze the market and its nuances. Here we sort of find another hidden trade-off, which is the trade-off between hyper-efficiency and generalization. Being hyper-efficient in one single thing means you will be bad at all the others. A mild but sufficient level of efficiency allows you to be good in many tasks simultaneously. Trading systems, on the other hand, can be fully automated because their techniques are simple mathematical formulas and rules based on technical indicators. However, as it was said already, even though an extremely low opportunity cost is attractive, you have to take into account the trade-off between automation and trade quality. Automated systems are simply not capable of generating the high-quality trades that a discretionary strategy can. Quantitative strategies are interesting because they need automation in order to work properly. These strategies are based on more sophisticated mathematical models or econometric models. These models are applied to a wide array of financial instruments in order to find trade opportunities. It's impossible for a human being to perform this task, especially when you imagine that all of this needs to be constantly updated in real time. In other words, without a certain level of automation, quantitative strategies are impossible to use. You need an analysis algorithm which will apply the econometric model to market data to filter opportunities, and you need an execution algorithm which will execute the opportunities that the trader selects at his own discretion. An interesting idea about automation emerges at this point. The idea is that when we talk about the financial markets, we should only try to automate the tasks that human beings cannot do, and not the tasks that human beings can do poorly. For example, we should not try to automate a strategy just to run away from cognitive biases. We should try to automate heavy mathematical work like in the case of quantitative strategies. Moving on to the fourth parameter, which relates to the adaptability of the techniques involved in the system, we have a few interesting conclusions also. Discretionary strategies are by far the most adaptive precisely because subjectivity is allowed into the mix. The possibility of human interpretation allows the maximum level of adaptability into the strategy, and that means that the techniques in a discretionary strategy can be used forever without the worry that they will expire, like what happens in trading systems. Here we arrive at another trade-off, which is the trade-off between the rigidity of trading techniques and the half-life of the system. The more rigid the trading rules and techniques are, the lower the half-life of a trading system. In the quantitative domain, we have an interesting situation. The rules and techniques come from an econometric model, so they are mostly objective with a little flexibility to incorporate human discretion. At the first impression, you might think that quant strategies have a lower half-life, but that's not what happens because quant trading strategies have a stronger scientific backbone, so their techniques can be generalized, which is something that doesn't happen in simple trading systems. Moving on to the fifth parameter, which is the expiration or half-life of the techniques used in the different approaches. Only the trading systems have a short expiration due to the lack of adaptability of the techniques involved and the simplicity of the system. Both discretionary and quantitative approaches deal with generalized techniques, meaning techniques that can be used for a long time without optimization or without changing the system completely. The expiration is actually a big problem in trading systems because these systems rely on some sort of market inefficiency. The issue is that these inefficiencies might vanish without notice, and then the system has to be optimized. Such trading systems are usually fragile because of that. The next parameter is learning complexity, meaning how difficult it is to learn a trading approach. Trading systems are without a doubt the easiest to learn because they involve simple techniques and they can be automated, so there is not much left for the trader to do other than monitoring and optimization. Discretionary and quantitative systems are much more complex to learn, with quantitative being the hardest due to the level of mathematics and statistics behind it. In the seventh parameter, we have the level of necessary infrastructure, meaning how much technology is needed to operationalize a particular trading approach. Discretionary strategies require the least level of technology. All you need is a trading platform that has basic drawing tools. Trading systems require a platform that allows algorithms to execute trades automatically, but you can also manually operate the system, even though there is no point doing that since it can be automated. Out of the three approaches, the quantitative is definitely the worst in this parameter because it requires a good analysis algorithm, an execution algorithm, and a reliable connection between these algorithms and a broker. In the eighth parameter, we have the applicability. Trading systems are the easiest to apply because they can be fully automated and they require minimal infrastructure. Discretionary strategies require little infrastructure, but they can be hard to apply due to the complexity in the analysis. Quantitative strategies are very easy to apply once you have the necessary infrastructure in place and you learn what the econometric model is doing. The ninth parameter is the scientific backbone, which is the level of scientific research supporting the trading approach. Out of the three approaches, the systematic approach is the worst one because it involves simple technical indicators and rudimentary technical analysis. Discretionary strategies have a much superior level of scientific substance, as it is the case in price action analysis using chaos theory and fractal geometry. Quantitative strategies are also deep in terms of science, since they are built on econometric models, which is the science that deals with the problem of analyzing and forecasting financial time series. The 10th parameter is trade quality. Discretionary strategies are the ones that provide the best quality in terms of precision. The systematic approach is the one that provides the worst quality in terms of precision. Quantitative strategies are not so much about the precision, but they are more focused on the probability of success of the trades. which is something that you can actually measure in the quantitative approach, unlike the other two approaches. As you can see, different trading approaches attract different types of traders for different reasons. All of them have advantages and disadvantages. The main point I want to make in this video is that you need to understand the implicit trade-offs in each trading approach so you can tune your expectations appropriately. Traders tend to focus too much on the bright side of the trade-off without giving the necessary attention to what they are giving up in order to collect the benefits. That's it for this video. This subject is actually broader than what it seems, so this video is just an introduction to spark your curiosity. If you want to learn more about trading, visit my official website fractalflowpro.com in the link available in the video description. If you wish to support the channel, please click the like button, subscribe to the channel, activate the notifications button, share the video, and leave your feedback below in the comment section. Thank you for watching and take care.